to begin.
Coming to you from the desert, somewhere in Arizona. It's here. The Impatient Investor with Andrew Lanoie.
It's him. He's alive.
If you're looking for new ways to generate wealth and passive income, you're in the right place.
You want it all, don't you?
You're in the right place. This is the podcast for those wanting to take control and gain freedom through alternative investments. If you're following your mom and dad's investment advice,
honey, I'm home.
Yeah, this isn't the podcast for you. Do you know what time it is?
Why, yes. Yes, I do.
I know what you're thinking.
This is going to be unbelievable.
It's time for the Impatient Investor with Andrew Lanoie.
Real estate investment trusts, or REITs, are a convenient way for inexperienced investors to gain exposure to real estate investing, especially for the first time. Modeled after mutual funds, publicly traded REITs purchase, own, and manage real estate properties. REITs give individual investors the opportunity to invest in a portfolio of income-producing real estate. Investors don't typically need a large amount of time or resources to invest in REITs, but for the savvy, smart investor, REITs should never be an option. Let's talk about recession vulnerability. REITs are highly vulnerable to recessions on two fronts. Because publicly traded REITs are highly correlated to the stock market, recessions always lead to an associated drop in REIT prices. In fact, since 2008, REITs have actually proven more volatile than the broader market. This is because the balance sheet of REITs are susceptible to external shocks. It is caused by the REIT's inability to retain significant amounts of cash flow, and without cash to ride out downturns, they are forced to liquidate assets at bargain prices. During the 2008 financial crisis, as stock prices fell, equity volatility for REITs increased. Not only are REIT share prices susceptible to recessions and downturns, but they are hypersensitive to market shocks compared to the broader market. Economic downturns not only affect REIT share prices, but with the associated reduction in rents, REIT profitability and dividends also suffer as a result. Now for the limited upside. A variety of factors limit the upside benefits of investing in REITs. One of the main downside of REITs is because they're highly leveraged, an increase in interest rates and therefore the borrowing rate directly impacts the cost of acquisitions and refinancing. And since rates are at an all-time low currently, chances are they will increase in the future. Here's a great quote. Besides, higher interest rates will eventually slow down economic growth and hurt occupancy rates, rents, and income payout rates. That was the author of Good, Bad, and Ugly REITs from Forbes. In the current environment, with historically low interest rates, the only way is up. Increase in interest rates will result in downward pressure on the bottom line of REITs, therefore limiting the upside potential. Another factor to consider limiting the upside benefits of REIT investments is the lack of diversification and competition. Most REITs specialize in a single property type, and a weakness in that particular segment of real estate could limit returns. This can be currently seen in the residential market. And imagine owning a REIT comprised of retail and office building assets. Because residential REITs have grabbed investor attention in recent years and has been flush with investor cash, this has resulted in a glut of supply. Usually, higher supply curtails the landlord's ability to demand higher rents and leads to lesser absorption. These may keep the growth momentum of rent at check. In the fourth quarter of 2006, the national effective rent growth increased 2.3%, and that was according to the early apartment data from Axiom Metrics. This was over 2 percentage points lower than the 4.6% rent growth experienced in the year-ago quarter. Also, occupancy of 94.7% in the fourth quarter was down from 95.1% in the third quarter and 95% in the fourth quarter of 2015. The lack of diversity and widespread competition can limit a REIT's upside prospects. A REIT's pre-established term can also limit the upside of its investment. Because REITs typically have a fixed maturity of 5 to 10 years, at some point the properties must be sold regardless of market conditions. That means if the REIT matures at any time when prices are down, a drop in your investment will be unavoidable. Finally, because REITs can only reinvest a maximum of 10% of their annual profits back into their core business each year, this limits their growth and upside potential as well. What about access to management? Investors often align their investment philosophy with that of the management who head the companies that they seek to invest in. As with most public companies, access to the management team of REITs is prohibitive. This limits an investor's ability to analyze a team's competence and vision going forward. For smart investors looking for recession-proof returns with unlimited upside and access to management, REITs should never be an option.
This was The Impatient Investor with Andrew Lanoie.
You'd do it again if you thought you could get away with it, wouldn't you?
Visit theimpatientinvestor.com for more episodes and be sure to share this podcast.
Now, don't tell me you're taking all this seriously.
No, seriously. Go share it and rate it on iTunes today.